Welcome to Factful Finance, the channel where we break down the complexities of finance into clear, actionable insights. Have you ever wondered how large-scale projects, like building bridges or launching renewable energy plants, get financed? The answer lies in a critical process called project finance. But here's the twist. Structuring a project finance deal isn't as simple as securing a loan. It's a meticulous process with multiple steps that requires a deep understanding of risk, return, and legal frameworks. Today, I'm going to walk you through the steps involved in structuring a project finance deal and how you can use this knowledge to make smarter financial decisions. Before we dive into the details, just a quick note. This video is for educational purposes only. For personalized advice, consult with a professional. Now let's get into it. Structuring a project finance deal involves several crucial steps, each designed to mitigate risk and ensure that the project can be successfully financed and completed. Here's how it breaks down. Step 1. Define the project structure. The first thing to do when structuring a project finance deal is define the project structure. This means identifying the project's key elements, such as the ownership structure, the roles of different parties, like contractors and lenders, and the overall financial framework. A typical structure might involve a special purpose vehicle, SPV, a company created solely for the purpose of executing the project. The SPV will own and operate the project, and this isolates the project's risks from the parent companies involved. Step 2. Assess the risk profile. Every project comes with risks: construction delays, cost overruns, operational inefficiencies, or even changes in regulation. Identifying and assessing these risks is critical. The risks are typically classified into 3 categories: construction risks, operational risks, and financial risks. Once identified, risk mitigation strategies are designed. This could involve using insurance, performance bonds, or contractual guarantees to protect against cost overruns and project delays. Step 3. Secure financing. Next comes the financing stage. Project finance is typically non-recourse, which means that the project's creditors can only be repaid from the project's future cash flows, not from the parent company's balance sheets. This makes securing financing a bit tricky. The lenders, be they commercial banks, development finance institutions, or even equity investors, will want to see detailed financial projections and risk mitigation strategies before they commit. The financing is usually structured in a mix of equity and debt, with equity investors providing the upfront capital and debt investors funding the bulk of the project costs. Step 4. Negotiate the contractual framework. At this stage, a robust legal framework must be put in place. This includes negotiating the contracts that define the roles and responsibilities of all parties involved. Key agreements include construction contracts, operation and maintenance contracts, supply agreements, and of course, the financing agreements with the lenders. Each of these contracts must be designed to allocate risk effectively, ensuring that no single party bears too much risk in case things go wrong. Step 5. Close the deal. Once the structure, risks, financing, and contracts are in place, it's time to close the deal. This involves finalizing all agreements, securing the necessary approvals from the relevant authorities, and ensuring that all funds are in place for the project to move forward. This step is often accompanied by final due diligence to ensure that the project can be successfully completed without unforeseen issues. Step 6. Monitor the project. Even after the deal is closed, the work doesn't stop. Monitoring is an ongoing process. Financial performance, construction timelines, and operational efficiency must all be tracked closely. Any deviations from the original plan need to be addressed quickly to prevent cost overruns or delays. So why does all this matter? Well, the global project finance market is enormous, worth trillions of dollars, and understanding how these deals are structured can give you a huge advantage. Whether you're looking to invest in large-scale projects or just want to understand how big infrastructure projects are funded, this process is essential. For example, let's consider a real-world scenario: a company looking to build a solar power plant. They would first define their project structure by creating an SPV to own and operate the plant. Then they'd assess the risks involved, like fluctuations in energy prices and construction delays. Once the risks are understood, they'd secure financing from a combination of equity investors and banks, ensuring that the project can be built without draining their own capital reserves. Next, they'd negotiate contracts with contractors and suppliers. And finally, after all agreements are in place, they'd close the deal and start construction. Throughout the life of the project, they'd monitor its progress to ensure it stays on track and within budget. As you can see, project finance is not just about the numbers. It's about managing risk and ensuring that all parties are protected. So, if you're ever involved in or considering a project finance deal, understanding these steps is crucial for success. Now, I want to hear from you. Have you ever been involved in a project finance deal? What steps did you find most challenging? Let me know in the comments below. And if you found this video helpful, don't forget to like, subscribe, and click the bell so you never miss an update. Thanks for watching Factful Finance, and I'll see you in the next one.